Welcome to Odisal Associates, Accounting and Finance Tutors. We are looking at some concepts in business combination. We've looked at 3 concepts already. We're going to look at this 4th one, indemnification assets. What is indemnification assets? Indemnification assets arise when the acquirer receives a contractual right from the seller to reimburse for certain liabilities or losses related to specific uncertainties, such as tax exposures or legal claims. These assets are recognized as part of the business combination process. Now, what it means is that indemnification assets arise as a result of contingent liabilities that the acquiree promise to make due or promise to pay the acquirer in case the contingent issue comes to materialization. It is something that we can say is the opposite of the contingent consideration we talked about, where additional consideration promised by the acquirer. Indemnification assets are what the acquiree promised the acquirer to indemnify him in case certain unknown thing happened in the future. We talked about taxes or some other legal claims. An indemnification asset is recognized at the same time as the indemnified item, provided that 1. The indemnified item is recognized at the acquisition date. 2. The indemnification is enforceable and collectible. And 3. The indemnified item is reliably measured. So we must look at this reliability and measurement. We must also know that if it's not enforceable, then we cannot say that it's an indemnification item or asset. If indemnified item is not recognized due to unreliable measurement, the indemnification asset is also not recognized. Here we are talking about indemnification item and indemnification assets. An indemnification item refers to a specific liability or loss that is covered by an indemnification agreement. So we are looking at a liability, or we're looking at a loss when we talk about indemnification item. So it's like a contingent liability. An indemnification asset, on the other hand, represents the right to receive compensation or reimbursement for a specific liability or loss that is covered by an indemnification agreement. So if there is indemnification item, there will be indemnification asset. The moment indemnification asset is created, then the liability is also created. Measurement principles. The indemnification asset is measured on the same basis as the indemnified item. So whatever basis you use to measure the indemnification item, that is the basis you use to measure the indemnification asset. If indemnified item is measured at fair value, the indemnification asset is also measured at fair value. If indemnified item is measured on another basis, the indemnification asset follows that measurement, adjusted for any contractual limitations and collectibility considerations. For assets measured at fair value, uncertainties and collectibility are included in the fair value measurement, and a separate valuation account allowance is not necessary since they have already been included. There is no need for us to do separate valuation for uncertainties and all the rest. Subsequent measurement of indemnification asset. After initial recognition, indemnification assets are measured on the same basis as the related indemnified item, subject to any contractual limitations and collectibility considerations. Now, we have talked about measurements. The next one we want to look at is the presentation and the disclosure. Indemnification assets are presented separately from the indemnified liabilities or assets in the financial statements, which means you are not going to set off one against the other one, but they are going to be presented separately. In disclosure, we should include things like the nature and terms of the indemnification arrangements, the amount recognized for indemnification assets, any significant assumptions or judgments made in measuring the indemnification assets. Examples of indemnification assets. We can have tax indemnification assets where there is a dispute, tax dispute, and it has not been settled before the business was acquired. And the acquirer recognized that there is a dispute between the acquiree and the tax authority, which might lead to payment in future. So this can lead to indemnification assets, so long as the acquiree makes a promise that if it comes out this way, I will pay so amount to reduce their loss or the amount you pay. 2, environmental indemnification assets. When the acquirer acquires an acquiree, and it happens that there is an issue of environment, we are talking about sustainability reporting now, where the companies are expected to report their impact on the climate. And where the company fails to do this, there are some costs that may be attached to it. And if the authority or the regulatory body comes and say that you did not do what you are supposed to do, and this dispute is still subsisting before the company is acquired, it may lead to indemnification assets, so long as the acquiree makes a contractual promise that gives him an obligation to pay some certain amount to the acquirer when the rights or the dispute materializes. Legal indemnification assets. Of course, legal indemnification assets covers even the first and the second one, because at the end it can, when you have a case, a legal case that might lead to the company being fined or penalty being placed on the company, and the acquirer is aware of this and requests that the acquiree indemnifies him if this thing comes into realization and the agreement is reached. Mind you that the agreement must be enforceable. If it's not an enforceable agreement, then it cannot lead to indemnification assets. Warranty indemnification assets. Where a company gives warranty to his customers Then until the warranty is over, the customer is tied to the company. If the warranty is not yet over and the item that was bought from that company develops fault, it's expected that the company that sold it will make good the item. So if such company is bought by an acquirer and he knows that he has given warranties to different customers and that these warranties might likely cost him money in the future, and this matter is contractually agreed that the acquiree will uh, pay some of the money that may arise from the warranty, then indemnification asset can also arise. Then it can also be through contractual agreement. These are various ways that indemnification assets can arise. Having looked at this, we're also going to look at a question in order for us to understand more what indemnification asset is. On January 1, 2024, Alpha Ltd acquired 100% of Beta Ltd for 500 million naira. As part of the acquisition, Alpha Ltd assumed a contingent liability related to a pending legal case against Beta Ltd. The fair value of this contingent liability at the acquisition date was estimated at 40 million naira. To mitigate potential losses, the former owners of Beta Ltd agreed to indemnify Alpha Ltd for any losses arising from this legal case, up to a maximum of 100 million naira. This indemnification agreement is legally binding and enforceable. By December 31st, 2024, new developments increased the estimated liability to 120 million naira. However, the indemnification remains capped at 100 million naira required. Explain how Alpha Ltd should recognize and measure the contingent liability and the indemnification assets at the acquisition date in accordance with Ifrs 3, business combination. 2. Describe how Alpha Ltd should account for the changes in the contingent liability and the indemnification asset as of December 31st, 2024. Illustrate how these items would apply in Alpha Ltd's statement of financial position as of December 31st, 2024. Outline the key disclosures Alpha Ltd should provide in its financial statements concerning the indemnification assets and the contingent liabilities. Okay, we are going to start with step 1, recognition and measurement of acquisition at acquisition dates. The indemnification asset is 40 million naira. So because of that, there is a liability of 40 million naira that will be also recognized. So we will debit indemnification assets and credit contingent liabilities. This is to show it at the fair value at the date of acquisition. Contingent liability that led to the indemnification asset is credited, while indemnification asset is debited. Okay, we look at step 2, accounting for changes as at December 31st, 2024. Due to some circumstances, the contingent liability increased from 100 to 120. So because of this, we are going to recognize the contingent liability at 120. Remember that we have already recognized 40 million. So it is the increase that we are going to add, which is 80 million. And then the indemnification asset was capped at 100 million. There was no change in that. So we are only going to get the difference provided for 40 million. 100 minus 40 will be 60. So we are going to increase what we have in our book by that 60. However, our account must balance. The remaining 20,000 will be written off in profit or loss. That's what informed the journal entry on the board. So because of the increase of the contingent liability, we have to debit profit or loss with 20 million and then debit indemnification assets with 60 million and then credit contingent liabilities with 80 million to account for the change in the fair value of the indemnification asset or the contingent liability. Okay, the extract of Alpha statement of financial position will be as follows. In the asset column, you have indemnification assets, 100 million. In the assets column, indemnification asset, 100 million. Now, let's know that the indemnification asset could be long-term or short-term. So it could be either non-current asset or current asset, depending on the time of payment. If it's to be paid within 1 year, then it's going to be current asset. But if it will prolong, it's going to be non-current asset. The same goes to liability. You are going to also show it in the liability side of the statement of financial position as contingent liability. But in this case, contingent liability is 120 million, not 100 million. Remember that the indemnification asset is the one that the acquiring promised to pay the acquirer. And he did not make another promise again, even though the liability has increased from 40 million to 120 million. There is nothing the acquirer will do but to bear that extra 20,000. So that is why you see indemnification asset is 100 million and the contingent liability is 120 million. Now you might think that the account with this, how would the account balance? Don't forget that we charged 20 million to profit or loss. So this will directly impact the retained earnings of the company, and the retained earnings of the company will be reduced. We can also bring it here as equity. If we want to say to show what will happen to equity, we can say equity retained earnings will be reduced by minus 20 million, which gives us a balance of debit and credit. Notes to the account. In the notes of to the account, we have an extract. The extract, the note will show that there was a contingent liability that was acquired from the company by Alpha Ltd. And the contingent liability was 40 million from acquisition, while the acquiree promised to pay 100 million in case it materialized as indemnification assets. That has been recognized in the account. But however, due to some circumstances, the contingent liability increased from 40 million to 120 million. Remember that the acquiree has promised that to mitigate the loss to the acquirer, Alpha, that is going to pay 100 million. Now, this is capped. It cannot be increased because that is what the agreement says. That is what is enforceable, and that is what can be collected from the acquiree. However, the contingent consideration increased to 120 million. That also have been provided in the account. In the note, you have also to disclose that the indemnification agreement is legally binding and enforceable with a maximum compensation limit of 100 million naira. The agreement covers losses arising from the pending legal case. The impact of this in the financial statement also has to be disclosed in the notes. Like the contingent liability and indemnification asset are presented in the statement of financial position as follows. Contingent liability 120 million, indemnification asset 100 million. You can also show the movement in the indemnification asset and the contingent liabilities as follows. Contingent liabilities. As at acquisition, 1st of January 2024, the contingent liability was 40 million. Subsequently, it increased from 40 million to 120 million. So you made another recognition of 80 million. 40 plus 80 gives you 120 million. That is total contingent liability that has been provided for in the account. Then the indemnification asset from acquisition, 40 million was provided for. And then increase of 60 million, which brought the value to 100 million. This disclosure provides transparency regarding the nature, amount, and terms of contingent liability and indemnification assets, as well as the impact on Alpha Limited's financial position. Illustration 2. On January 1st, 2024, Company Alpha acquired 100% of Company Beta for 800 million as part of the acquisition. Alpha identified a contingent liability related to an ongoing legal dispute, estimated at a fair value of 60 million. To mitigate potential losses, the former owners of Beta agreed to indemnify Alpha for any losses arising from this legal case, up to a maximum of 60 million naira. This indemnification agreement is legally enforceable. The fair values of Beta's identifiable assets and liabilities at the acquisition date were as follows. Identifiable asset, excluding indemnification asset, 100 million. Identifiable liabilities, excluding contingent liability, 300 million. Required. Determine the amounts to be recognized for the contingent liability and the indemnification asset at the acquisition date. Calculate the goodwill arising from the acquisition. Prepare the relevant extract of Alpha's consolidated statement of financial position immediately after acquisition. This illustration, I have brought it in order to also show how indemnification assets affects goodwill computation. Under IFRS 3, business combination, contingent liabilities or liabilities and assets are recognized at fair value. In these transactions, we have seen that there is a contingent liability that gave rise to an indemnification asset. And the question said that the fair value of the contingent liability is 60 million. And also the indemnification asset is 60 million. So this 60 million is what will be recognized as contingent liability and as indemnification assets. Of course, the indemnification asset will be debited 60 million naira, while contingent liabilities will be credited 60 million naira. This is how they will be recognized in the account. The question requires us to compute the goodwill computation. The company was acquired by Alpha with a consideration of 800,000 naira. And the question also stated that the identifiable assets acquired was 1 million naira, excluding the indemnification assets. So it means that the total identifiable asset acquired will be the asset acquired plus the indemnification assets, which will give us 1,060,000 naira. Of course, to get the net asset is total assets minus total liabilities. So we look at the identifiable, we remove the identifiable liabilities and the contingent liabilities. The identifiable liabilities is 300,000 and contingent liabilities 60,000, which makes total liabilities to become 360,000. So if you remove the net asset, the liability assumed from the asset acquired, you have 700,000. Now our net asset is 700,000. You less 360,000 total liability from 1,600,000 total asset. You have 700,000. If you remove that 700,000 from the consideration transferred by Alpha, you have 1,100,000 naira. So that is our goodwill. Extract of consolidated statement of financial position, the post-acquisition extract, is in millions. We have assets, identifiable assets, 1 billion, sorry. Indemnification assets, 60 million. Goodwill, 100 million. Total assets, 1,160 million. This is what is going to appear in the asset side of the consolidated statement of financial position of Alpha. Then the liability side, we have indemnification and identifiable liabilities, 300 million. Contingent liabilities, 60 million. And total liabilities, 360 million. That will be 300 plus 60. We can also derive the equity from removing the total liabilities from the total assets. So net assets will be equal to 1,160,000,000 minus 360 million. That is 800 million. Remember that net assets is equal to equity. Now we have demonstrated indemnification assets when we did not include goodwill. We have also demonstrated it including goodwill. So I am sure that any question on indemnification asset will be easy for you to handle. I'm going to give you an exercise that I expect you to try in the comment section. I'll give you the solution later after I have read what you people have done. Abiye Ltd acquires 100% of Joy Ltd. Joy Ltd has a tax dispute issue where they claim that the highest liability expected was 5,000 naira. But however, if it is beyond that, they will settle the difference. Abiye Ltd reliable information was that the amount will be as high as 15,000 naira. How will Abiye Ltd account for this transaction on consolidation? Give your answer in the comment section. I will provide the model answer later in the comment section. So we have dealt with indemnification assets. I feel that the problems that are associated with indemnification assets have been handled in the right way. I know very well that just listening to me without practicing it, you will not be able to actually do it when you are faced with such problem. But if you go back and practice it, you will be able to handle it. That's why I am giving you exercise for you to look at and then test your understanding. I'm going to give you the solution after I have seen that several people have attempted it. This is indemnification assets. Thank you very much for watching. Thank you for following. Thank you for sharing with your friends. Thank you for commenting. Thank you for also looking at our other social media platforms. Be part of us as we grow together in finance. Thank you.